It's Tuesday, March 24th. The national debt crossed $39 trillion on March 17th, just 5 months after hitting $38 trillion, and it's growing at roughly $7.2 billion per day. The Congressional Budget Office's February outlook projects a $1.9 trillion deficit for fiscal year 2026, rising to $3.1 trillion by 2036, with debt held by the public reaching 120% of GDP and surpassing the post-World War II record by 2030. Net interest payments alone are projected to hit $1 trillion this year and double to $2.1 trillion by 2036. In the CBO's own words, the fiscal trajectory is not sustainable. But even these projections may already be outdated. The Pentagon is seeking $200 billion in supplemental war funding on top of the $150 billion Congress already gave the Department of War in last year's Reconciliation Act, none of which is reflected in the CBO baseline yet. Meanwhile, the Supreme Court struck down the IEEPA tariffs on February 20th, and the CBO estimates that this ruling could add $2 trillion to projected deficits over the next decade. The bond market is already starting to reflect higher government outlays, with the 10-year Treasury yield climbing to roughly 4.42%, up almost 12% since the Iran war began on February 28th. So what does not sustainable look like for the economy, and are we headed for a debt crisis or even outright default? What needs to change? Follow for more daily updates. Our next guest is the person responsible for telling Congress exactly how deep this fiscal hole runs. Joining us now is Phillip Swagel, the director of the Congressional Budget Office. Dr. Swagel holds a PhD in economics from Harvard University and previously served as an economist at both the Federal Reserve and the U.S. Treasury during the 2008 financial crisis, where he helped design TARP and sat on the investment committee that decided which banks received bailout funds. Dr. Swagel, it's an honor to have you back on the show. Welcome back.
Yeah, David. Thanks very much.
It's a pleasure to have you back on the show, Phillip. What changed since the last time we had you on the show in fall 2024 versus now? We'll talk about that. We'll talk about the projections that the CBO has published recently this quarter. And I want to start by talking about how the Iran war may or may not change your budget projections. The Pentagon is requesting an additional $200 billion in supplemental funding for the Iran war, on top of the $150 billion that Congress already gave the Department of War in last year's Reconciliation Act. And the CBO's existing $1.9 trillion deficit projection for the fiscal year does not include any supplemental war spending. So should it be approved, Phillip, how would the budget change?
No, very good. It's something that CBO tracks, and in the past, the agency has provided Congress with this information on a regular basis. I'm thinking back to the days of the U.S. involvement in Iraq and Afghanistan. There were regular CBO updates about the overseas contingency operations. The OCO was the budget nomenclature. And we would provide that again. It's a little bit too soon for us to do it yet. We don't know the duration of the conflict. We don't know the scope, the ultimate scope of it. And we would rely on the administration for that information. So we're watching, we're waiting. Yeah, there's a lot of people wanting this information, and we will provide it as soon as possible. But it's just a little bit too soon to know this yet.
For a conflict such as this, how long does it usually take for the CBO to estimate how expensive ultimately it might be?
It really depends on the nature of the conflict. And that's why with Afghanistan and Iraq, the CBO eventually settled into a regular pattern of updates. And you can see that in our baseline updates, the ones that you just mentioned that we published in February 2026. If you go back to the ones that were published in 2013, 2014, and so on, those had regular updates. And in fact, one of our senior managers is the one who originated that. Those just recognizing that there was broad interest and providing that in a regular format. So we'll do it. It's just a little hard to do it yet when so much remains unclear and unknown about the conflict.
I think the general public may just be wondering right now, Phillip, how their expenses or outlays are going to change when there is a shock to the budget, such as an Iran war that's lasting a little bit longer than already initially projected? In other words, will our taxes increase? Will there be cuts to social programs that have already been budgeted? Any changes to our regular life besides inflation, which we'll talk about?
Okay. Yeah, it's again, it will depend on the nature of the ultimate nature of the conflict. Um, if the conflict ends relatively soon and within a few months, and energy prices go back to where they were before the conflict, well then, they're not likely to be a huge impact that would be long, looking back in retrospect. It's just hard to know what the impacts will be because it depends so much on the outcomes and the duration and scope of the conflict.
So when it comes to inflation, you told me last time on the show, deficits can't cause inflation, but it depends on the interaction with monetary policy. So with gasoline prices going through the roof, with diesel now seeing a new crisis at just under $5 a gallon, what do you think should be the calculus for the Federal Reserve right now?
Okay. Yeah, it's something that we're watching, and obviously the Fed is as well, is how much does the energy shock that we're all seeing and that you just mentioned, instances transmit through to broader measures of inflation. And again, if the shock is relatively short-lived, energy prices revert back to where they were before the conflict, then that, of course, it affects families and affects budgets, household budgets, but it's not a long-lasting effect on the economy or on inflation. If the conflict is longer lasting and the impact on energy prices is long lasting, well, then that affects inflation, and eventually it'll broaden out from the energy into broader measures of inflation. It's just we're still at the early stages of this, so it's still just hard to know.
Let's show the audience the projection here from the
very good. Yeah, thank you.
from
Yep.
the
So this is
most
the statement
recent.
on the publication of our budget outlook. Yeah, thank you.
Absolutely. So last year, when I had you on in 2024, the fiscal year 2024 deficit was roughly 1.83 trillion, and the CBO now projects 1.9 trillion for fiscal year 2026. Is it fair to say that not a lot has changed in terms of outlays and receipts from 2024 to now?
It's interesting, and right, it's kind of where you started with the changes since you and I last talked.
Yeah.
There's a lot that's happened. I mean, right, we have a new administration. I mean, President Trump's second term.
That's right.
There have been large tariffs put on. There was a very large reconciliation bill passed. The president signed into law on July 4th of last year. So there's huge changes. It changed outlays. It changed revenues. And yet there's some things that are the same. The fiscal deficit is still large, still around nearly $2 trillion in our projections for this year and rising. The debt to GDP, where you started the show, is also remains large and rising. So yeah, that's this is the nature of the last year or two. There's big changes, but netting a lot of these things out, the overall fiscal trajectory remains in some qualitatively similar.
How have tariffs changed government receipts? The claim is that the deficit was narrowed somewhat by higher tariff revenues. Is that true, according to your numbers?
Yeah, that's right. So in our February 2026 baseline projections, we had the tariffs reducing deficits by $3 trillion over the 10-year budget window. As by way of comparison, the 2025 Reconciliation Act increased deficits by 4.7 trillion. So the tariffs did not, exactly offset the entire cost of the 25 Reconciliation Act, but a good chunk of it. So they did raise revenue. Now the Supreme Court decision, I guess is 3 weeks ago now, as we talk, eliminated some of the tariffs, the ones that were passed by the IEEPA, the Emergency Economic Powers Act. And we calculated that would increase the deficit by about $2 trillion. So the elimination of those tariffs. Now, the administration has, since taken other actions. They've put on a 10% tariff using other authority. They've talked about changing that, from 10 to 15. And we're still analyzing that. But for sure, the changes in tariffs have large impacts on revenues and therefore on the budget deficit and also on the economy.
Are you in your office assuming then that if tariffs were struck down by the Supreme Court, there wouldn't be any changes to economic activity? In other words, more spending, I guess more demand because tariffs are no longer in place, thereby increasing government taxation revenue simply from more economic activity, not so much from tariffs being collected. Is that
Right.
is that the assumption here?
Right, from the other activity. No, it's a good point that the tariffs of this size have macroeconomic effects, putting them on or taking them off. And in our budget baseline, we did look at those instances, the macro feedbacks between the tariff policy and the macro. And we discussed it in the outlook. We haven't done that yet for the Supreme Court decision or the subsequent administration actions. And we will. In a sense, we need to wait for the administration's actions to settle down and for us to get a sense of where the eventual tariff policies will end up. But it could have a macroeconomic feedback, absolutely.
Generally, how does a CBO make economic projections for GDP or growth, if that's something that's within your domain? Because ultimately, you do have to project how the economy will grow in order to roughly estimate or speculate as to how much tax receipts will grow proportionally to spending.
Oh, okay. No, very good. And I'm smiling at the estimate, speculate. The word we use project, that we project, but estimate.
Okay.
Yeah, estimate is fine, and speculate. I mean,
we don't speculate. We project. All right.
Yeah. No. I totally understand the meaning there. Yeah. Sometimes, I catch myself before I use certain words. So that's where I catch myself.
I understand, Philip.
Before using them. You understand. But it's a challenge of the job. Is that exactly as you said? We have to have a projection for the economy in order to do our other projections of outlays and revenues. And revenues is natural, right? That where the economy goes drives the receipts that the federal government takes in. But there's also spending that is geared to the economy. If the economy is strong, well, then there's certain means-tested spending that'll be lower. There'll be fewer people unemployed. There'll be fewer people getting food. What used to be called food stamps are now SNAP benefits, supplemental nutrition assistance program benefits. And so the economy does matter, and it matters both on the spending side and the revenue side.
So that leads me to discuss the director's statement, which we showed earlier. Going down to this particular sentence here, our budget projections continue to indicate that the fiscal trajectory is not sustainable. We discussed this in 2024. It seems like the CBO is doubling down on this view. Can you just elaborate more on why your view is that this is not sustainable?
Yeah. If you scroll back up just a little bit to the debt, to that chart, just put that chart in view. That is the challenge, and this is a stocks. This is the debt held by the public as a share of GDP, and you can see it just keeps going. And compare it to what happened in the 1940s. So you can see, of course, we had World War II, and in the 1940s, the debt rose as the U.S. government borrowed. This is the sort of all these famous posters of buy war bonds, and then the debt was paid off in large part by the generation that fought the war, and now the greatest generation. And now we see on the right-hand side of the screen the debt ratio. Exactly. Yeah. Thank you. Where you're pointing, the debt ratio going up and not coming back down. Now that's under current law, and it's one of the one of the ways in which we construct our estimates is current law. This is a stock, but there are flow measures associated with it, interest payments or other things that would be very challenging at some point as the debt continues to rise.
So this is unprecedented for the United States in terms of how far the debt to GDP will climb. However, we can look at other G7 nations, perhaps at Japan, as maybe a proxy to see how their economy performs under such high debt loads. Can we do that, Philip? Is that fair to do?
Yeah, I mean, that would be one way of looking at it. And this, as you said, Japan has also a high debt to GDP ratio. There's other countries, Belgium, and some others. Um, Japan's economic performance it's still a rich country, of course, a very advanced country, but it has had decades now of slow growth. And a part of that is a demographic challenge in Japan, but the debt ratio is probably also an impediment to growth. Um, and so it gives us insight. The U.S. remains a special economy. I mean, the dollar has a special place in the world economy and financial system. So we have some advantages. That's why we're continuing to indicate that the debt is not sustainable, but it's not that there's a crisis tomorrow or the next day or anytime soon. It's what we mean is that action needs to be taken to change the fiscal trajectory. But it's not that it has to be done at any one moment. It just has to be done over time.
So when you warn that the fiscal trajectory is not sustainable, what does that mean, practically speaking? I mean, we're not talking about a debt default, sovereign debt default, are we?
No, I mean, no, absolutely not. And of course, the U.S. borrows in dollars, and the U.S. government creates dollars. So, eventually, the unsustainable fiscal situation would show up as investor concerns about U.S. securities, that show up as higher interest rates or a weaker dollar, but more likely higher interest rates since the dollar has to be weaker against something. It could be higher inflation eventually. And so it is kind of aspects of economic policy or economic developments that would undercut our prosperity. So it's not like a sharp, I'm chopping my hands. It's not like a sharp, we fall off a cliff, but it'd be a slow undermining of our shared prosperity.
If the central bank were to monetize the debt, meaning they were to create new money to purchase existing debt, would that solve the problem?
I mean, it would result in high inflation, right? That would be, in some sense, it's almost like a form of a soft default, right? The U.S. is paying back the debt, but paying back in dollars that are worth less. Now, of course, we are, way, way, way far away from that. And the Treasury Secretary has talked about reducing the deficit. He's talked about stronger growth, 3% growth, and a 3% deficit. So, so that's the policy of the administration, is to take on this problem, and that's that's what's needed, and so that's why I think we're still very far away from the kind of high inflation world.
I think importantly, the interest payments on this debt will rise. And so your February 2026 outlook projects that net interest payments will rise from roughly $1 trillion this year to $2.1 trillion by 2036. That's rising from 3.3% of GDP to 4.6%. In your monthly budget review, it shows interest costs rising already 8% year over year through February. So at what point does this higher interest payment eat into other government spending programs such as Medicare, Medicaid, Social Security, and so on?
Yeah. I mean, that is really the challenge that you've put your finger on, is that the rising interest payments such as crowd out other priorities, and crowd out in the sense of policymakers have to consider the overall fiscal picture. And dollars going to one thing can't go to another thing. And so either we need, lower spending on other things, or higher taxes and more revenue. And that's the way in which the figures, the interest figures that you point to are a policy challenge.
I know it's not the role of the CBO to actually enact policy and change legislation, but in the past, you've studied this a lot. What typically happens when interest payments go up as a percentage of GDP? Have we seen higher taxes? Have we seen just cuts? What changes?
Oh, I see. Yeah, it's that's a good question. I don't know if there's a historical precedent for what happens
Okay.
because it's really up to policymakers and the adjustment could be in either direction or in both. It could be more revenue, it could be lower spending, it could be some mix of that. And from CBO, we don't recommend particular solutions to policymakers. We don't say do this or do that, but we just say some action needs to be taken, and then we support the Congress as they decide what to do.
You have a forecast on real GDP growth as well, which I'm going to show on the
Mhm.
screen in just a minute. It assumes,
Okay.
I think a real percent, yeah, here we go. A real GDP growth rate, long run of 2% or just under
Yep.
2%,
1.8. That's right.
1.8%. And you're assuming that your projections of economic growth incorporate a positive effect of generative AI on productivity growth, amounting to an increase of about 10 basis points per year. A lot of people and members of Congress are concerned about the negative effects of AI on the labor market. In
Mhm.
your projections, have you accounted for the possibility of more layoffs and higher unemployment from the rise of AI, thereby probably reducing consumer spending and demand? Or is that not a baseline projection for you?
Okay. No, it's a great question. Um, so as you say, there's going to be disruptions from AI, and we're starting to see some of that in the labor market already. Um, on the other hand, there are potentially large gains to productivity, to incomes, and to overall GDP. Um, and that's the challenge is figuring it out. This is the mix of the gains and the disruptions and the relative costs. So what we've done so far is we looked at the improvements to productivity in the activities that we already analyze. And so this is the like coders or programmers, as people my age would call it. Um, right, it increases their productivity. We have that already in some of our internal activities. The use of AI has increased our internal productivity. And so that's the basis for the 10 basis point increase in productivity. Then there's the changes and disruptions and opportunities. And there's going to be new jobs and new occupations and things that we don't even contemplate. I mean, who would have thought of a podcaster 30 years ago, right? I mean, there's radio shows and now like news radios are shutting down and podcasters are taking over. So yeah, so we're watching that. We know there's going to be both positives and disruptions, but and so we just don't have a basis yet for that. And so that's something that CB will be watching in the future.
Yeah, podcasters taking over radio. In the future, you'll probably be talking to a robot instead of a real person. We'll
No,
see what kinds of
it's
questions.
yeah. I mean, look, I'm positive. I'm pretty optimistic about the economy,
Yeah,
in recognizing the disruptions. But AI is making us more productive, and that's what I
yeah,
would see, right? For your research, you'll have an AI agent helping you with your research and
absolutely,
identifying questions. You still need to use your judgment. Okay, what's the right question and what's the right
absolutely.
follow-up? And it's the same thing. We're trying to figure out how to use this best.
We have a few minutes left, so before we close off, let me just ask you how you think the budget may change. Or sorry, let me rephrase that question.
Sure.
What milestones or markers in the economy would move your budget projections either way, either a
Ah.
reduction in the deficit
Mhm.
or higher deficits into 2027?
Oh, okay. Okay. No, no, very good. That's a great question. All right. So let me just tick off a couple things we're watching. One is what happens with tariffs. Right. We had the Supreme Court decision. The administration has responded in part already, and now is undertaking a number of investigations based on their tariff authorities. And so we're watching those to see where those go, what those mean for the economy, what those mean for revenues. So that's one thing is looking at revenues. The president will put out a budget at some point later this spring. We're watching for that. We're watching for any supplementals, like you mentioned earlier, for to fund the conflict in Iran, or with Iran. Um, and then we're watching growth and productivity, including the positive effects of the 2025 Reconciliation Act on the economy, and in particular the tax provisions, right? So the 25 Act extended the lower taxes from the December 2017 Tax Act. Those have a positive effect on investment, and then from there to growth and employment. We have a pretty optimistic view of those, but there are some people who think that we're not optimistic enough. And we're watching. We're trying to distill, well, what is the effect of the 2025 Act on the economy, on investment, on job creation, and then compare that to our projections. And so that's another big milestone that will play out this year.
My final question, and maybe you can answer this in 1 minute or less. The projections that the CBO have put out have caused a lot of concern in the economic community. This is just an ex post that I saw today. Negative numbers exclude Social Security and Medicare. CBO projects add another $50 to $70 trillion in unfunded obligations over the next 30 years. Economists like Steve Hanke and David Walker, Steve Hanke is a regular in my program, wrote in Fortune on March 23rd that these numbers constitute insolvency under any standard accounting framework. Can you just make a statement to the general public on basically reacting to this kind of sentiment, which is very commonplace amongst economists, looking at the numbers that the CBO have released?
Okay. Well, so first of all, I would follow the Treasury, and I would not use that word. The fiscal trajectory is challenging. It's daunting. It's unsustainable. Markets clearly believe that we as a nation will take action to address this challenge, and the Treasury Secretary has talked about taking action, and that's what I look to. They have, this is the targets that would make a meaningful adjustment in our situation, and implicitly markets believe that we as a nation will take action to address this challenge, because you look at financial markets, and the dollar remains the number one currency in the world. The U.S. Treasury funds our deficits. Investors have confidence in the U.S. We continue to grow and create jobs. So so that's why I think it looks challenging, daunting, but I remain optimistic.
Okay, thank you very much, Phillip. And I encourage everybody to check out the CBO's projections, links down below. You can look at their projections and any changes in detail. It's beyond the scope of a 25-minute conversation today. But thank you so much, Phillip, for lending us your time and informing the public. I appreciate it. Thank you.
Yeah, thanks, David. Pleasure. Okay.
Thank you for watching. Don't forget to like and subscribe. Take care.